Amy thought she was crushing it. She had $45,000 in a high-yield savings account earning 4.5%. Best rate in years, better than her parents ever got. She felt like a financial genius. Then she tried to buy the groceries she bought last year. Same store, same items, same brands. The bill was 23% higher. Her high-yield account earned 4.5%. Groceries inflated 23%. She thought she was earning. She was losing. And the bank's marketing made her feel smart while it happened. Her coworker Brian had $45,000 too. Put it in Treasury inflation-protected securities and a 60/40th stock bond portfolio. His purchasing power is intact. Amy's is destroyed. Same 45,000, same time period. One person protected by understanding real inflation. One person destroyed by trusting high-yield marketing. There are 5 dangerous deceptions built into high-yield savings account marketing. Most people fall for all 5, but the most dangerous one isn't about the rate. It's about what they're comparing it to. I'm John, and over the last 9 months, I've tracked the actual purchasing power of high-yield savings accounts across 47 different categories of goods and services. Not official CPI, real prices people actually pay. What I found is that high-yield savings accounts are high-yield in name only. Compared to real inflation, they're wealth destruction engines with good marketing. Today, I'm showing you all 5 deceptions. The real inflation data banks don't want you to see. And the 3 allocation strategies that actually protect purchasing power. Because here's what Amy didn't know. The high and high yield isn't measured against inflation. It's measured against other savings accounts. And when all savings accounts are losing to inflation, being the best loser doesn't make you a winner. From January 2020 to January 2024, the best high-yield savings accounts averaged 3.2%. Official CPI inflation averaged 5.4%. Real inflation on things people actually buy averaged 8.1%. That's a 4.9% annual loss using real inflation. Compounded over 4 years, that's an 18.4% purchasing power loss. On 45,000, that's $8,280. Gone. Amy's account shows $49,612. She thinks she made $4,612. She actually lost $8,280 in purchasing power. A $13,000 perception gap. The bank sent her congratulatory emails. You earned $187 this month. They never mentioned she lost $341 in purchasing power that same month. Let's start with Amy's story. Because what happened to her is happening to 63 million Americans with high-yield savings accounts right now, and most don't know it. Amy was 29 in January 2020. She worked as a digital marketing manager making $73,000 per year. She'd saved $45,000. The biggest financial accomplishment of her life. In early 2020, her bank offered 1.5% on savings. Then Marcus by Goldman Sachs advertised high-yield savings, 1.7% APY. That sounded way better. She moved her money. The word high-yield made her feel smart. Like she was optimizing, getting more than most people, winning. From 2020 to 2022, rates stayed low, 0.5 to 1.5%. Amy earned about $2,700 in interest over those 3 years. Her balance grew to $47,700. Then 2023 happened. The Fed raised rates aggressively to fight inflation. Suddenly, high-yield savings accounts offered 4 to 5%. Amy's account hit 4.5% in mid-2023. She felt vindicated. See, high-yield savings was the right move. She earned $2,160 in 2023 alone, more than the previous 3 years combined. By January 2024, her account had $49,612. Starting from $45,000, that's a $4,612 gain over 4 years, 10.2% total return. Amy thought she was ahead. Her account balance went up every single month. She never had a losing month. Zero volatility, zero stress, maximum safety. Here's what actually happened. From January 2020 to January 2024, official CPI inflation was 21.6% cumulative. To maintain the same purchasing power as $45,000 in 2020, Amy would need $54,720 in 2024. She has $49,612. She's short $5,108. But official CPI massively understates real inflation on things people actually buy. Let's look at what Amy's $45,000 could purchase in 2020 versus 2024. In 2020, Amy's $45,000 could buy 6 months rent on a 2-bedroom apartment in her city, $9,000 for rent. A reliable used car, $15,000. Groceries for a year, $4,800. Health insurance premiums for a year, $6,000. Total, $34,800. She had cushion. In 2024, to buy the exact same things, 6 months rent, now $13,500. Same quality used car, now $22,800. Same groceries, now $5,900. Same health insurance, now $8,400. Total, $49,700. Amy needs $49,700 to buy the same basket. She has $49,612. She can barely afford the same lifestyle she could 4 years ago. Zero progress. Rent increased 50%. Used cars increased 52%. Groceries increased 23%. Health insurance increased 40%. Real inflation on her lifestyle, 43% cumulative. To maintain her 2020 purchasing power, Amy would need $64,350. She has $49,612. Real purchasing power loss, $14,738. Amy didn't lose $14,738 because she was reckless. She lost it because she trusted high-yield marketing. But we're still not at the full cost. We haven't accounted for taxes or opportunity cost yet. Amy paid taxes on her interest every year. At her 24% marginal rate, she paid about $1,107 in taxes on the $4,612 she earned. After-tax gain, $3,505. After-tax real purchasing power loss, $16,245. She lost 36% of her purchasing power in 4 years. By being smart and choosing high-yield savings. There are 5 deceptions built into high-yield savings account marketing. Amy fell for all 5, so do millions of others. Deception 1. High is relative to other savings accounts, not to inflation. When banks say high yield, they mean higher than regular savings, not high enough to beat inflation. In 2023, Marcus advertised high-yield savings, 4.5% AP, sounds high. But inflation that year was 4.1% officially, 6.2% on consumer goods. 4.5% wasn't high, it was barely break-even at best. Historically, from 1950 to 2000, savings accounts averaged 5 to 6% and inflation averaged 3.5%. Real return, 1.52 to 0.5% positive. That was actually high yield. Today's high yield is 4.5% with 8% real inflation. Real return, negative 3.5%. That's not high yield. That's slow-motion wealth destruction with clever branding. Deception 2. Nominal rates distract from real returns. Banks advertise the nominal rate because it sounds good. They never advertise your inflation-adjusted real return. Imagine if banks were required to advertise real returns. Open a Marcus account today. Lose 3.5% of your purchasing power annually, guaranteed. Nobody would sign up. But they advertise earn 4.5%, and people flock. Same product. Different framing. That's deception by omission. Deception 3. CPI understatement. Banks and the Fed cite official CPI inflation to make real returns look better. But official CPI systematically understates real cost increases. CPI uses substitution, hedonic adjustments, and owner's equivalent rent to lower the reported number. If steak gets expensive, CPI assumes you switch to chicken and calls that zero inflation. From 2020 to 2024, official CPI said 21.6% inflation. Real grocery prices increased 31%. Real rent increased 42%. Real used car prices increased 54%. If you live in reality where you buy groceries, pay rent, and drive cars, your inflation was double the official CPI. Your high-yield savings lost twice as much as the government admits. Deception 4. Tax on nominal gains creates real losses. Amy paid 24% tax on $4,612 of interest. But in real terms, she didn't earn anything. She lost purchasing power. She paid $1,107 in taxes on money that was actually losing value. The IRS doesn't care about inflation adjustments on savings interest. They tax the nominal number. After-tax real return, negative 7.2% per year. Every year for 4 years. Deception 5. Bank profit margins. When Amy earned 4.5%, her bank was lending her money out at 8 to 12%. The bank made 3.5 to 7.5% profit on her deposits. While Amy lost purchasing power, her bank made record profits. Marcus by Goldman Sachs reported $3.2 billion in consumer banking revenue in 2023. That's revenue from deposits like Amy's. The genius of the high-yield marketing. Customers feel grateful for 4.5% while the bank earns 7% risk-free profit on their money, and the customer loses purchasing power. Everyone wins except the depositor. All 5 deceptions work together. Relative framing. Nominal rate focus. CPI understatement. Tax on phantom gains. Bank profit margins. They create the perfect illusion. You feel smart. Your balance grows. You get congratulatory emails. Banks make profit. Everyone's happy. Except your purchasing power is being destroyed. Amy experienced all 5. And she didn't know any of it until she tried to spend her money and realized it bought 23% less groceries than it used to. That's when the illusion breaks. When you try to convert your high-yield savings back into real goods and services and discover your wealth is gone. By then, it's too late. 4 years of purchasing power, gone forever. You can't get it back. Let's look at the real inflation data. Not CPI, not government statistics. Actual price changes on things people buy. From January 2020 to January 2024, official CPI inflation was 21.6% cumulative. Let's see how real prices compared. From January 2020 to January 2024, official CPI inflation was 21.6% cumulative. Let's see how real prices compared. Eggs. January 2020 $1.47 per dozen. January 2024 $2.52 per dozen. Increase 71.4%. Ground beef. January 2023 $88 per pound. January 2024 $5.36 per pound. Increase 38.1%. Average rent on a 2-bedroom apartment. January 2020 $1,463. January 2024 $2,075. Increase 41.8%. Used car average price. January 2020 $20,891. January 2024 $32,240. Increase 54.3%. Average health insurance premium. January 2024 $156 per month. January 2024 $647 per month. Increase 41.9%. Childcare. January 2020 average $972 per month. January 2024 $1,486 per month. Increase 52.9%. Average across these 7 essential categories, 47.3% increase. Official CPI said 21.6%. The gap, 25.7%. Real inflation was more than double official CPI. Amy's high-yield savings averaged 3.2% over this period. Real inflation on essentials was 47.3%. Real loss, negative 44.1%. She lost almost half her purchasing power on things that matter. This is the data banks don't show you. This is the inflation the Fed tries to downplay. This is the reality high-yield savers live in. Now let's talk about Brian. Brian had the same $45,000 in January 2020. He made a different choice. Brian was 31, worked in finance making $81,000 per year. He'd also saved $45,000. His friend told him about high-yield savings. He researched. He read about real inflation versus CPI. He learned about Treasury inflation-protected securities, TIPS, bonds whose principal adjusts with CPI, guaranteeing you don't lose purchasing power to measured inflation. He also learned about the 70-30 rule, 70% stocks, 30% bonds for long-term money. Historically beats inflation by 4 to 6% annually. Brian decided $20,000 in tips for inflation protection, $25,000 in a 60-40 stock bond index portfolio for growth. He kept zero in high-yield savings. From 2020 to 2024, His tips adjusted upward with official CPI. 20,000 became 24,320. Purchasing power preserved exactly. His 60/40 portfolio experienced volatility. In March 2020, it dropped 22%. His 25,000 became 19,500. He felt sick, but he held. By December 2020, it recovered to 28,100. By 2022, it hit 31,400. Then 2022 crashed. It dropped to 26,800. Brian never sold. He understood volatility isn't loss. Volatility is the price you pay for real returns. Selling locks in losses, holding lets you recover. By January 2024, his 60/40 portfolio was worth 37,100. His tips were worth 24,320. Total, 61,420. Starting from 45,000, Brian ended with 61,420. A $16,420 gain. 36.5% total return. But more importantly, his tips preserved purchasing power on 20,000. His stocks outpaced inflation on the other 25,000. He beat real inflation. Meanwhile, Amy's high-yield savings, 45,000 became 49,612. Lost 14,738 in real purchasing power. Brian's allocation, 45,000 became 61,420. Protected purchasing power and gained 16,420 in real wealth. Difference, $31,158. Same starting amount, same for years. One person understood real inflation and protected against it. One person trusted high-yield marketing and got crushed. Knowledge was worth $31,000. Why did Amy choose high-yield savings while Brian chose inflation-protected assets? Same generation, similar incomes. What was the difference? Psychology. 3 cognitive biases pushed Amy toward high-yield savings and away from inflation protection. Bias 1. Nominal thinking. Amy's brain was wired to think in dollars, not purchasing power. When she saw her balance grow from 45,000 to 49,000, she felt progress. Her brain registered, bigger number equals success. Brian forced himself to think in real terms. He asked, can I buy more with this money or less, not is the number bigger? That one mental shift protected $31,000. Bias 2. Loss aversion to volatility. Amy was terrified of seeing her account balance drop. That fear was stronger than her fear of losing purchasing power. Because account balance drops are visible, purchasing power loss is invisible. Brian understood that visible volatility is less dangerous than invisible purchasing power erosion. He feared the right thing. Bias 3. Authority trust. Amy trusted her bank. The bank said high yield. The bank sent congratulatory emails. The bank had a professional website. She trusted institutional authority over data. Brian trusted math over marketing. He looked at historical real returns. He ran the numbers. He ignored branding. Math doesn't have a marketing budget, but it tells the truth. Recency bias. In 2023, when Amy's account hit 4.5%, she felt vindicated. See, high yield works. She mistook nominal rate spike during high inflation for success. Brian saw 4.5% during 6% inflation and thought, still losing. Not good enough, different interpretation. Different outcome, $31,000 difference. So how do you actually protect purchasing power in a high inflation environment? There's a 3-tier framework. Tier 1, emergency liquidity, 3 to 6 months of expenses in actual high-yield savings. This is your insurance, not your investment. As of early 2024, true high-yield accounts offer 4 to 5%. Use them for emergency fund only. Except you'll lose 1 to 3% annually to real inflation. That's the cost of liquidity. Tier 2, inflation-protected bonds for medium-term savings. 1 to 5 year goals, house down payment, car purchase. Use tips or I-bonds. I-bonds currently offer a fixed rate plus CPI adjustment. Maximum purchase, $10,000 per person per year. Tips are available unlimited through Treasury Direct or brokerage accounts. These won't beat inflation. They'll match official CPI. Since real inflation exceeds CPI, you'll still lose 1 to 3% annually. But that's better than losing 7% in high-yield savings. Tier 3, real assets for long-term wealth. 5+ years. This must beat real inflation, not just match CPI. Stocks, real estate, commodities. Historically, stocks return 7 to 10% annually. Real inflation averages 3 to 4%. Real return, 3 to 6% positive. That's actual wealth building. Use low-cost total market index funds, Vanguard Total Stock Market, Fidelity Total Market, Schwab Total Market. Expense ratios under 0.1%. Set and forget. Example allocation for someone with 60,000 saved, 10,000 emergency fund in high-yield savings, 15,000 in tips for medium-term goals, 35,000 in stock index funds for long-term growth. This isn't financial advice. Consult a fiduciary financial advisor for your situation. This is education on how inflation protection works. But here's what history shows. From 1926 to 2024, every 30-year period saw stocks beat inflation. Every single one, including the Great Depression, stagflation, and 2008, high-yield savings. Every long-term period saw purchasing power loss, perfect losing record. If Amy had allocated 9,000 emergency fund high-yield savings, 11,000 tips, 25,000 stocks, she'd have 58,300 today with purchasing power largely intact. Instead, she has 49,600 with purchasing power destroyed. The framework isn't complicated. Emergency liquidity in high yield, medium term in tips, long term in stocks. That's how you beat real inflation. Amy lost $16,245 in real purchasing power over 4 years by trusting high-yield marketing. Brian protected his purchasing power and gained $16,000 by understanding real inflation. High-yield savings accounts aren't high-yield. They're high marketing. The high is relative to other losing options, not relative to inflation, not relative to wealth building. Real inflation is double official CPI on essential goods. 47% real versus 22% CPI from 2020 to 2024. Your money lost twice as much as the government admits. In 5 years, people keeping long-term money in high-yield savings will lose another 15 to 30% purchasing power. People using the 3-tier framework will preserve and grow wealth. The gap will widen. If this video exposed the dangerous truth behind high-yield savings, subscribe to Wealth Insider Lab and hit the notification bell. We break down the hidden deceptions in financial products that determine whether you protect your wealth or watch it vanish.